Are you a buyer or seller looking to buy or sell a condo in today's market? I'm Renee Velasquez with the RSVP Group with eXp Realty, and this is Hey Andy, where I ask Andy Rigda with Edge Home Finance questions about current topics that are affecting the real estate market. Recent changes just occurred that could really disrupt the condo market. And we want to help you avoid any missteps as a buyer or seller. And today we're going to be talking about those condo changes. Hi, Andy.
Hey Renee, how are you doing?
Good.
All right.
Hey, Andy.
Yes.
So condo changes have happened. They've just gone into effect, right?
hmm
Right.
August 3rd.
August 3rd, they went into effect, and it is August 20th. And most people probably haven't even heard about these changes. We hope that most real estate agents and lenders have, but that may not necessarily be the case. So, what happened in the condo market in the land of financing?
This really pertains to your conventional loans. So Fannie Mae, Freddie Mac, they're the ones who buy all the conventional loans. They made these changes across the board for all condos that really kind of stricken the guidelines and the rules in order to get them approved. If you don't know, condos have to be approved in order to be financeable, right? And so, in order to get them the financing that you require and take advantage of those conventional loans, like if you're a first-time home buyer to put 3% down or and get a great rate, it's going to be a little bit harder to get those condos approved so we can get your loan approved. So we want to make sure that everyone's got the information that came out so that we can work around it if we have to.
You mentioned they have to be approved. So we already had some things in place with condos where buyers that were FHA approved or VA approved may have had some challenges in purchasing condos, right?
Right. And they kind of flipped the script where FHA may actually be a little bit easier now where it was a lot harder before. So, but we'll get into that later once we talk about what these changes are.
Interesting. Okay.
Yeah.
So we had some challenges for FHA buyers and VA buyers for condos. Now
Mhm.
the challenges may lie on the conventional borrowers. Is that right?
That's absolutely right. Yeah. So the big one is the reserve requirements. And I know a lot of people probably don't know what the reserve requirement, what their insurance is on the condominium, unless they're super involved in the HOA that's associated with their complex or their development. But the way it really works is that the lender provides the HOA with a questionnaire. They have to answer the questionnaire. And it's basically on the financing and the stability of the complex because I mean, let's be real. Every lender wants to make sure that their interest is protected when they loan you hundreds of thousands of dollars. They have to make sure that the asset that they're lending on is a good asset, right? And it can support not only the value, but the stability. So, what they don't want is a condominium complex going bankrupt all of a sudden, and then a private equity group, takes it in, kicks everybody out. Hey, this is a rent only condominium now. So, in order to prevent that, they have to make sure the financials are stable in order to protect that long term investment. Because, as you know, most loans are 30 years, right? So, we have to look not just 1, 2, 3 years down the road, they have to look potentially 30 years down the road so that when that loan reaches maturity, their investment is protected as well.
Right. So the whoever is basically running the HOA, they would need to fill out this questionnaire, would ask questions like how many of the units are rentals, how many of them are owner occupied, what the
Mm-hmm.
insurance is that they carry, right? How much in
Mm-hmm.
reserve funds they have based on what
Mm-hmm.
they're collecting, based on the repairs they're doing, those types of things, right?
Correct. So there's two dates that are critical. The first one is August the 3rd, which has already passed, and they're putting in these changes where the reserves are higher now than they were before. What they also changed is there was a streamlined approval process, and now that's gone away. So it's a full entity approval process. So it could go one of two ways. If the project passes the approval, right, then everybody can finance, and we don't really have to go through that again because now it's listed as it's already went through that process once. So it will streamline buyers 2, 3, and 4 down the road. However, right now, because we're only a couple weeks out of this, it's really going to impact people now. People buying now are going to get impacted. And then come beginning of 2027, early January, we're looking at new insurance requirements. So like there's a minimal deductible per unit that will be looked at as well. So not only are we going to have to incorporate these changes in the next couple months, we get another change come beginning of the year, 2027.
So let's go ahead and address the very first change. So the very first
Mhm.
change, or one of the changes, is that the amount of reserves that the HOA needs to have
Mhm.
has changed from 10%.
10 to 15%.
So it went from 10% was the old rule, now it's
Mhm.
15%.
Correct.
Who will that impact and what does that look like?
If your condominium complex is operating on a shoestring budget, it's going to be a problem. There are ways to work around it, lender specific. So, I'm obviously a broker. I have many different options, so we can shop around because a lot of lenders will create kind of their own overlay, right? They'll put their rules on top of the rules. So maybe we don't meet the reserve requirement because their reserve account is too low, but maybe we can aggregate those with other accounts that are earmarked for other payments so that we can combine those in order to make that 15%. But I'm going to tell you right now, the more traditional banking institutions are pretty much just going to stick at, hey, what do you have in this account? No, okay, I can't do it.
So what we're saying in layman's terms is that lenders that maybe once before were able to lend on particular condo complexes will no longer lend on those complexes because they may have gotten under the radar or in there with 10% reserves, but now that they need 15%, those particular lending institutions are going to want them inside that box. And hey, we can't do this because they won't look at a larger picture, right? They just want, is that kind of what we're saying?
Yeah, that's exactly right.
Okay. So someone like you who's a broker, you may be able to look at that condo complex a little bit differently and say, yes, obviously the rule is 15%. We can't skirt that rule, but we may be able to look at it a little differently to where the math actually ends up equaling that 15% that they need to have, and therefore you can lend on that condo.
Correct. And going a step further, sometimes, depending on the lender, if they had lent in that same condo complex previously and have a questionnaire on file, we may not have to jump through all those hoops because we may already have the financials from a previous transaction. Even one that happened prior to these changes, if those financials show within a specific amount of time that, they do meet the new requirements, then you can kind of skip that whole thing and move forward on it. But again, if they're not completely approved, if maybe this one specific condo was approved for that transaction, and now where we're at today in August of 2026, the whole project hasn't been approved. We still have to go through that process to get that project approved. So what that's going to mean for, not just borrowers and sellers, but also agents like yourself, we may have to increase our expectation and timelines of when that's going to close because now we have extra steps in place that will be required in order to meet the new guidelines.
So what I'm hearing you say is in a typical real estate transaction, from the time we accept a contract to the time we close, we're looking at in between 30 to 45 days. Most are trying to keep it within 30 days. You're saying that when we write those contracts, we need to be aware of this and we may need to post it, 45, maybe even 60 days out on those contracts to get those in-depth reviews done?
Well, it's going to be hard to say because this is not just a Medina County problem. It's not an Ohio problem. This is a USA problem. I would like to say, yeah, maybe more towards that 45-day mark, but now we're going to have backups because now all the condos that are being sold across the entire country kind of have to funnel in the Fannie Mae or Freddie Mac, pipeline to get approved. Now we're going to have a national bottleneck on these projects, and it's a new process, right? So there's a learning curve. So maybe there's going to be a little bit of dancing around to get that thing done, but yeah, at the end of the day, it's going to take a little bit longer.
So for sellers who are thinking about going on the market, they may need to anticipate holding on to that condo a little bit longer, especially if they are moving on to something else, upsizing, downsizing, whatever they're doing. They may need to say, hey, I'm not going to be able to sell my condo within the amount of time that I thought I was going to. It's going to take much longer of a process, and I'm not even sure how much longer of a process that's going to be. So the last thing I want is for all of my things to be packed up in a U-Haul with my expectation of moving my stuff into the new home. As soon as I get the proceeds from the sale of this house, I
Mhm.
go and purchase my next house and then move all my stuff in. There may be delays on my sale, which means I'm not going to get my funds fast enough to go ahead and turn around and purchase my next house within the time allowed. So I may need to really work through what those timelines look like. And then on the
Mhm.
buyer side, same thing. I don't want to necessarily be turning in my notice to my landlord saying, hey, I'm moving out. I just bought a condo and now I thought I was going to be moving out of my apartment in 30 days. And now it's actually going to take 60, 65, 70 days because of this new process. I need to know that I have a place in the interim or that I've actually, we wrote a contract that allows for all of that process to get through. Is that correct?
Yeah, that's right. And you take it a step further now, if there's a contingent offer from the sale of this condo on the next property, and as you know, these can kind of domino, everything's getting pushed out. So, at that time, depending on if you're a seller, what do you have as far as equity in your property? Perhaps this would be a good opportunity to get into some type of a bridge loan product so you can move that next transaction along further and allow for the time on the back end to happen on the sale of your house and not have to worry about that payment and still access most of those proceeds so you can go into the next house. It's going to take some creativity, but there's going to be workarounds if you're creative.
So let's talk about the workaround. So we might have some friction with financing on condos. Does that
Mhm.
mean that a cash buyer for a condo might have kind of an unfair advantage? I mean, we all think that cash is king anyway, right? They already have an unfair advantage.
Yeah.
However, because of how quickly we could get finance deals done and how the market was working, taking a conventional, offer, even an FHA offer over a cash offer, if those other offers were higher, still made sense. So in this
Mhm.
condo world, though, if we know that we may have this friction because we've got this deeper dive in the review of the condo complex, does that give cash buyers an unfair advantage? Like, hey, you don't have to worry about any of that stuff with me, and you'll get your money within the time frame that we put on the contract. No delays. Here we go.
Yeah, I mean, if you're talking guaranteed time frames, and I mean, the money's going to talk, right? Everything else walks, as the saying goes. So if you do have the cash, that would be a way to move things along. So perhaps if you're downsizing and you're looking to go from a bigger home to now you want a maintenance-free living lifestyle in a condominium, and you have that equity in place on your house, you could become that cash buyer and not have to really wait for that main house to sell to get into the next one. And then, we could get into delayed financing if you don't want all your reserves, and all that kind of stuff. But if you're up against a cash buyer and you can guarantee a timeline, especially if you're on an expedited schedule, it just may make sense to go that route.
Now, that's one workaround if you have cash,
Mhm.
right? Cash is king.
Right.
You can always work around stuff with cash.
Mhm.
What's our workaround if we're a buyer in this market, we know that we want a condo because we want maintenance-free living, but now we're afraid of these changes. And our goal here isn't to create fear, it's to give people options and to let them know what their options are
Right.
so they can make educated decisions. Is
Mhm.
there different routes within financing that we can take to maybe not we're not circumventing the rules, but we're avoiding some of the friction that may be caused by these new rules that just came out?
Workaround one is still an FHA loan, right? The streamlined process still exists. They didn't take that away from us. It still has to pass all the, earmarks that it currently does. But perhaps because we won't have this giant bottleneck, that may be the quicker option, and that may be the way to go and still be able to get in on that 3.5% down product. But again, still has to pass everything. So the changes didn't happen. That makes it, easier. But now it seems like the FHA process is easier than the new conventional process.
Got it. So does that mean that that condo complex would already have to be FHA approved, or are we able to go in and do what's called like a spot approval? Tell us more about that.
Yeah, so spot approval is basically the way the conventional worked before. You can get just your unit approved and get that done a lot quicker than trying to get the entire complex approved or the entire project approved. That process still exists.
Okay, great. Now, is there risk to that? Could you attempt to do a spot approval on a unit and just have it not be able to be spot approved?
Yeah. So, and that's where really working with knowledgeable lenders and realtors like yourself so that everyone's prepared with the expectations up front, gathering all the documentation that you can, getting our ducks lined up, starting that process early, or even if you're a seller, perhaps getting those documents lined up so when you need them on an FHA transaction, you have them and there's not a lot of going back and forth. And I mean, HOA board members, that's not their full-time job, right? They still go to work, they still go do stuff, they still have life, they have, maybe have kids or grandkids or what have you. So they're involved in their own life. You selling that condo is not high on their priority. I mean, it's just the way it is, if we're going to be honest. So having a lot of those documents ahead of time so that you can go into it with all the information up front. Now, if there's an issue getting that FHA approved for that condo transaction, there are other financing options that we can take advantage of. Now, you get what's called a non-warrantable condo. So conventional FHA, VA, that's all what's called QM, right? That's the main banking and lending that we have today, which spurred from the crash of 2008, right? Everything's got to fall inside specific guidelines. That's called QM. Now you have what's called non-QM, and non-warrantable condos fall in that non-QM category. And non-QM basically has lenders that are willing to take on the risk that maybe the Fannie Mae, Freddie Mac conventional lenders will not take on, and they'll allow you to still get in it if they don't pass these approvals. So there's a couple different ways to go about that. The first one, they're always going to require a questionnaire. So they may not require as many financials and they may not require as many stipulations. And some lenders actually have their own internal warrantable condo process. So it'd be the difference of putting, say, 20% down. Hey, it just doesn't pass and nothing we can do about it, can't get it through, but you can still finance it 20% down. Well, you kind of skip all the approval stuff, right? You just move past it. It's not approved, 20%. We got a normal timeline on our loan. If it's warrantable within the lender's guidelines, their own personal guidelines, these aren't the federal guidelines, the lender's own guidelines, they can call it warrantable, and then you can do as little as 10% down. So it's a little bit of, it is higher risk because it's not passing the conventional standards. However, it's definitely a giant door open for people to be able to purchase this without having the full 20% down.
So what you're saying is rather than going the, and I'm going to use air quotes all the time, the
Okay.
traditional financing way, where we're
Sure.
following the Fannie Mae and Freddie Mac guidelines,
Mhm.
we are then going to a lender that has their own guidelines
Mhm.
that they may say, hey, even though you can't get it done this way, we have a product, we have a program in which you can purchase this condo with even less down. Is that right?
So 10% would be the very least down. Whoops, very least down if we went to a non-QM product. If it just doesn't pass and they're being sued, there's a ton of HOA delinquencies, they obviously don't have the reserves. Maybe their insurance isn't quite up to par. That's just not going to pass. Even the lender's internals, right? But they make it very minimal, right? They don't make it as strict as it is today with the conventional guidelines. But yeah, if they can pass it internally in their own system, that's a 10% down. If it just can't pass, then we're looking more like a 20% down.
Okay. So, but they could still get it done.
They can still get it done. And if we move in that route, that it's a lot faster process.
When we do these, we never want to bash other lending institutions or anything like that. We're just giving some facts here. So,
Mhm.
would somebody be able to walk into their bank and get a non-QM situation?
Well, um,
Can I ask you
is
a
that a
lead
loaded question? Yeah. So normally no. And there are banks that offer non-QM products, but the experience generally is it's underwritten like a QM product. So in layman's terms, hey, we have flexibility, but we're still going to stay on our process because they're banks and they're lending their depositors money out and they can only lend so much money out. And there's guidelines for them to stay in. They have extra guidelines in place that they have to stay within. So they're not going to be as liberal as, say, a specific non-QM wholesale lender would. And you just don't walk into these places and apply for a loan. It's generally through a broker like myself. And if, lender A doesn't like it, maybe lender B will like it, because it is lender specific on those non-QM guidelines.
So as a buyer, if you're in the market looking for a condo, the last thing we want to do is say, oh, you can't buy them. That's not what we're saying. We're saying that
Right.
the process has changed, that it
Mm-hmm.
may take longer, that the review process is a little bit more stringent. There's more requirements, heavier requirements. There are options for you. You could go to a non-QM lending institution or lender, which could help you get this transaction done and get it done within a normal time frame because you won't be
Mm-hmm.
part of that bottleneck of everybody across the nation trying to get these condo contracts through. So you may be able to buy it within the same time frame as you were before these rules came down the pike. You just need to
Mm-hmm.
make sure you're working with the appropriate lender. And are there a couple of questions that we can arm our buyers with when they're interviewing lenders or they're talking to lenders on whether or not they're going to be the lender that works for them?
In general, right, it's going to be the normal course of conversation. Is your lender educating you? Are they giving you the answers that you need? And I'll be honest, we don't know all the answers, but are you willing? You know what? I don't know that. Let me get back to you, and then they do get back to you. Those that's like the overview, right? When we're getting specifically through condos, are they asking the right questions to you, the buyer? What's the address? Let me look it up. Let me see if it might already be on the HUD list and we don't have to worry about it. All right, it's not. Do you know if we have the financials available? And then explain why this is important, why we need these extra things, what the new changes are, and really educate the borrower on how we can get this done and what steps are required to be necessary. And if those steps that we take don't give us the answer we want, what's plan B? Always come up with a plan B. Do we have multiple solutions to this problem? And I think that's important for a buyer to hear because they just want to hear no, right? No, I can't. No, we don't do it. That's just not our thing. Well, we're going to try option A and we have option B to fall back on.
So if someone were to apply for a loan and they know that they're specifically looking at condos because they want a maintenance-free situation, and that lender just pumps out a pre-approval and says, here you go out shopping, that might be a red flag.
Oh, for sure. If your lender doesn't know what kind of property you're searching for, giant red flag. They should not only know what kind of property you're looking for, where you're looking for, specifically what market you're looking to get into. And maybe, if you have an idea of properties in your head, maybe they can preemptively look them up to see what the next steps are going to be if you decide to put an offer in on that property. So yeah, you really have to know, you got to be armed with knowledge. And if you have a lender that's willing to give you that knowledge and give you that education, I think that's where the good fit lies.
And for sellers are like, well, why would I need to care about what, where these buyers are coming from, what type of loan and who they're going with? For sellers, what I'm hearing you say is it's really important that they work with a real estate agent that is obviously going to market their property appropriately, but also have someone like you to where they can lean on and say, hey, Andy, what are the documents that we need to have at the ready so that when we do have to go through this process, we already have them available. And then also, if for some reason we get in a situation where the buyers have lenders where they're not familiar, that they're not asking these right questions, that we have a plan B to step in and be able to get them across the finish line so that the sellers aren't going under contract with a particular buyer. They're using a lender that, hey, we can't get this approved. It doesn't fit within this box. Or, hey, we're in the pipeline. It's going down, but we're at that bottleneck. I have no idea when it's going to come out the other
Yeah.
side and leave you in
Mm-hmm.
the lurch. We need to have a backup plan so where we're not having to release that contract, go back on the market. Then, of course, everybody asks, why is it back on the market? Is there something wrong with the property?
Mm-hmm.
Sellers need to know what to have, what to be ready for, and have options and plan Bs and plan Cs in place to where if they can't get this buyer to the finish line, we have different options to go to, right?
Absolutely. And then when we're a knowledgeable real estate agent as yourself, you can let the client know when they do receive an offer that the offer itself, like I don't know how many times I've gotten a call from a listing agent that says, what is non-QM? Why is that on your pre-approval letter? And I'll be more than happy to break it down. And they're not knowledgeable of the different programs available that will have that financing available. So for example, if you have multiple contracts, in multiple offers given to you, you have the ability to explain to your seller, you know what, we have a conventional offer, we have an FHA offer, and we have a non-QM offer. And we already looked up this property on the HUD website and we know it's not approved. This non-QM buyer is going to come in. We're going to bypass all of that. And, that may be the best option because this conventional loan, the time to close on this one is 60 days. FHA is 45. This non-QM one, we can close it in 21 days and you can buy that next house. It may be worth a couple $1,000s to accept that, move on, because if you go with the higher offer, but it's conventional and it bombs out, then everything you just explained about having to go back onto the market, re-explain, that could really come into effect and be detrimental to their ultimate selling price.
Makes total sense. So we're going to wrap this up. Thank you so much for answering these questions. Of course, we could probably talk for another hour and a half about these changes and ways to work through them or have different options. How can they reach you, Andy, if we've got a buyer out there that is looking to purchase a condo and wants to make sure they're working with a lender that has a plan A, a plan B, and a plan C? How can they reach out to you?
Yeah, great. You can call me 440-315-0650, andythemortgageman.com. Real easy to find me.
Love it. And I am Renee Velasquez with the RSVP Group with eXp Realty. I'm a realtor here in Northeast Ohio. So if you're looking to buy or sell in Northeast Ohio, please feel free to reach out. I'm 330-321-3339. You can also find me on all of my socials, Instagram, Facebook. I'm Renee Velasquez or the RSVP Group. Thank you so much, and we'll talk to you next time on Hey Andy.
We'll see ya.